Welcome back. You're watching us here on Chartbusters on CNBC-TV18. I'm Mangalam Maloo, with me Nigel D'Souza. A brief glitch in the markets as we speak, flattened out for the Nifty, the mid-caps having it worse. But the new kid on the block is Juniper Hotels. Made its debut on the exchanges, listing at a mild premium to its issue price of close to 365 rupees per share. Rather, 365 rupees is where it listed versus the issue price of 360. And thereafter, it saw a big surge of 11%, currently at around 401. We have with us Arun Kumar Saraf, who is the chairman and managing director of the company, joining in. Thanks a lot, Mr. Saraf, for joining in. A slightly softish listing, and that was lapped up by the street. What's more important is what happens to your balance sheet and income statement going forward itself. The last known debt of the company, close to 2,200 crores. You've said that you will look at reducing this debt. What I want to know is, what is the glide path of debt reduction over FY24, FY25 and FY26? And what would be the absolute savings in finance costs?
Thank you, Mangalamji. Thank you very much. First of all, thank you for having me on your show. We have raised 1,800 crore rupees from the markets, and we had a very, very enthusiastic buy-in and start for the stock. Out of the 1,800 crores, 1,500 has been earmarked for deleveraging, and we will be deleveraging that within next couple of days. And 300 was kept for our corporate growth in the coming years. Out of this 1,800 is out of 2,100, 1,800 is our debt from the banks. And out of that 1,800, we are reducing it. 1,500 will go back to be paid. And going forward, it is not our intention actually to deleverage, and that is not our goal. Our goal is to grow this company to the next level. This is what I call Juniper 2.0. And this growth is going to come partially through the new raise and partially through the surpluses that we are generating on a year-to-year going forward. This year we will be closing the year, the first year, that is 24, will be our historical year, and we will in 25 we will have a surplus of almost 500 crores coming into the company as part of the EBITDA, and we would be able to save interest costs by deleveraging almost 275 crore rupees per annum. That also becomes available to the company for future growth. So our real trajectory at this moment is going to be that we are going to keep our debt level below 2 multiples of EBITDA. We will use the money to leverage, to acquire new assets and grow the company. So in the combined effort, we will be investing more than 1,200 crore rupees going forward in next 2 years is our plan.
Okay,
from
all
right. Both loans and by way of our surpluses from the operations.
All right. Hi, Mr. Saraf.
Please.
Good morning. This is Nigel on this side. First of all, congratulations. The street likes the stock. You know, after a tepid listing, it's quickly got gobbled into, and the stock is up 12%. So there's great expectations from here on. I missed that number, the EBITDA number that you were talking about, 500 crores in FY25. Is that what you're guiding for?
Yes,
Okay.
absolutely. FY25 is targeted for 500 crores.
Got it. And what
And
about...
we have a very, very clearly laid out plan going forward.
Okay, got it. And what about the revenue trajectory from here on? You know, say in the next 3-4 years, what's the number that you're looking at? If I look at your last year as it is, you've already done a fairly good, you're close to 670 crores of revenues. And this year, in all probability, I guess you'll be closer to around 800 crores plus. What's the trajectory? You know, with the kind of growth
Absolutely.
plans that you have, with the kind of internal cash accruals, capacity addition, how do you see the revenue trajectory move ahead?
Sure. This year we are planning to cross 800 crores. And going forward, we see a growth of almost 12 to 14% in our revenue targets every year, year on year. And we have both organic growth, and in 27 you will start seeing the inorganic growth that we will be adding on new capacities into the company by greenfield and brownfield projects. So this is going to be a journey that is now charted. Mm-hmm.
No, go ahead. You were talking about the growth prospects of the company.
Sure. So we have a very, very clear-cut charted strategy in the company, and we are going to be acquiring new assets this year, and we have earmarked certain assets, and we will be actually having a good growth in our own revenue because of our market the hospitality sector actually overall has performed well last year, and going forward, we expect it to perform very nicely for next 2-3 years.
All right, so final question before we let you go. You have close to 1,836 keys as of September 30th, 2023. What is your, asset expansion plan from here on over the next 2 to 3 years? You said you have earmarked 1,200 crores for the next growth strategy. And will it be concentrated towards the Hyatt brand of hotels itself, or will you look at some other brands as well?
We are open to Hyatt and any international or domestic brand which is going to fit into our assets. Going forward, we are intending to add 1,000 more keys over the next 2 years into our portfolio of assets. And this is a journey that is now starting. Juniper 2 is starting, and we are very hopeful to achieve these targets.
Okay, all right. Juniper 2 is something that the street will look forward to, Mr. Saraf. But for the time being, they're appreciating Juniper 1 as well. Congratulations to you, your team, as well as your family. It's a solid listing.
Thank you very much.
And we're going to hold you on these numbers in the time to come. Well, for the time being, though, we'll slip into a short break. When we come back, we'll be joined by Mr. Hemant Jalan, the Chairman and Managing Director of Indigo Paints. You stay with us.